Are you feeling the pinch of an economic slump? Are you worried about how to make the most of your investments during tough times? If so, you won't want to miss this video. We'll show you the secrets to maximizing your returns even when the market is down, so you can come out on top and thrive during challenging economic times. If you're a beginner investor and haven't yet started to invest, you can open your first brokerage account with Acorns and start your journey today. Click the first link in the description to know more. Now on with the video. Despite the remarkable resiliency shown by the US economy in the face of slowing growth trends this year, it is still not the ideal environment to be taking on additional risks. Our view is that investors should exercise caution and consider incorporating a few downside portfolio tactics into their investment strategy if they haven't already done so. We have identified a number of portfolio strategies that we believe can help weather economic downturns and protect your investments. So, without further ado, let's take a closer look at these strategies and explore how they can benefit you in the long run. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. And make sure to stay till number 1 as it is the most important one on the list. Number 6. Strategic Portfolio Realignment. Prioritizing U.S. stock and bond positioning. In times of uncertainty and slowing global growth, the United States has often served as a reliable port in the storm, offering a degree of relative stability to investors. From our perspective, the U.S. has made significant progress in its normalization process, which could mean that any economic downturn experienced domestically may be less severe compared to other regions like Europe or emerging markets. Furthermore, the U.S. boasts a higher concentration of companies that exhibit more visible profit streams and secular drivers of growth. As a result, we anticipate the U.S. will be one of the primary regions leading the world out of an economic downturn, providing attractive investment opportunities for those who position themselves strategically. Comment stocks if you would like us to make more videos like this in the future. Number 5. Prioritizing investment quality and income generation in stock selection. Investing in assets that prioritize stable or growing profits, even in an economic downturn, can potentially lead to outperformance compared to assets that are more materially affected by such conditions. Moreover, income generation tends to become a crucial factor in the return equation during a low or negative return environment. Defensive sectors, such as utilities and consumer staples, are excellent options for investors seeking reliable dividend-paying opportunities, as are financials and healthcare. Technology companies that systematically pay and increase their dividends may also offer exposure to income-generating investments. However, investors must be careful and selective when choosing investments and companies. By tying the quality and income themes together, investors can add a defensive posture to their portfolio while maintaining equity diversification. This approach can potentially help investors navigate challenging market conditions and achieve their investment objectives. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. Number 4. Embracing diversification. The key to reducing investment risk and maximizing returns. One of the most effective ways to reduce investment risk and maximize returns is by adopting a risk-based portfolio approach that incorporates a range of assets, including stocks, bonds, alternative investments, and cash. This diversified approach can help mitigate the impact that a stock market downturn can have on your portfolio compared to an all-stock portfolio. However, the current economic climate has put pressure on both stocks and bonds, reducing the diversification benefits of a simple 60% stock and 40% bond portfolio. Despite this, declines in bonds have been less severe than in equities, and alternative investments and cash have helped to add a layer of relief to a well-diversified portfolio. As a result, a diversified 4-asset portfolio has typically experienced less loss than the overall stock market this year and has reduced volatility. We firmly believe that these principles will continue to hold true if economic conditions worsen, underscoring the value of diversification in a well-rounded investment strategy. Number 3. High-quality bonds. a long-term attractive option for stability. The current 10-year U.S. Treasury yield is among the highest levels recorded since 2011, presenting investors with an opportunity to lock in yields that we believe are attractive for the more stable part of a portfolio. Although there is a risk that rates may continue to climb higher, high-quality investment grade and government bonds can help to reduce the volatility of other areas of the portfolio, such as equities, while also providing a source of income. While there is always some degree of risk in the bond market, investing in high-quality bonds can offer a measure of protection against market volatility and serve as a valuable tool for achieving long-term investment goals. Number 2. Start considering other strategies. In a volatile and uncertain environment, a little flexibility can go a long way in helping a portfolio manage a downturn. Trusting capable managers to make intelligent choices about asset allocation across sectors, regions, and investment types can help to make a portion of your portfolio more responsive and dynamic. Alternative strategies such as systematic trend funds, equity market neutral funds, multi-strategy funds, and non-traditional bond funds have shown to respond well to rapidly changing market conditions this year. These strategies rely on a manager's ability to respond more dynamically to shifting macro-micro trends driving asset prices over a shorter window of time. The flexibility in these strategies allows for quick mitigation of declines and/or taking advantage of brief opportunities. We recommend that investors consider utilizing these strategies in their portfolios, particularly during high market volatility or deteriorating economic conditions. By doing so, investors may potentially mitigate downside risks while taking advantage of opportunities presented by changing market conditions. And finally, number 1, maintain discipline, seize opportunities, dollar cost average, and focus on long-term goals. To avoid being caught off guard when the market shifts, it's important to stay prepared and flexible. By implementing the strategies mentioned above, investors can stay afloat and ready to take advantage of opportunities when they arise. This approach will allow investors to adjust their positions accordingly without being too defensive or reactive. In the current environment, market volatility is likely to persist amid slowing economic growth and rising interest rates. The uncertainty surrounding various variables also raises the risk that economic conditions could remain challenging in the near future. However, we think the current market prices have factored in some of the potential negative impacts of these factors. As a result, we suggest investors avoid overreacting and straying significantly from their long-term asset allocation goals, which are meant to withstand multiple economic and market cycles. So that's it today for you guys. And don't forget to check out Acorns by clicking the first link in the description. Thanks all. Bye.